Hey, you always hear people talk about let's get bigger, let's grow more, let's add more. And that's great. And it totally fits into our belief that we all should try as best we can. And hopefully you ask us to help you with it to build a residential real estate portfolio that generates passive income for you. But then how do you actually grow to a really, really large portfolio and what implications are associated with that? And to talk about that, we brought in Toby Mathis from Anderson Advisors because what they do is, on the one hand, they provide tax strategies on how you can actually use your assets and reduce the amount of taxes that you have to pay. But it goes beyond that because when you start growing, you will need to have an estate plan and you want to protect your assets from any kind of negative impacts. And so those three things together is what Toby is actually an expert in. So I invite you to listen in and see how you can take care of your assets and your taxes and protect everything together with their advice. Hello and welcome to another episode of the Ideal Investor Show. Today we have a guest that will help us understand what are all the things to protect what we have and maybe even be able to hand it over to the next generation. And he is one of the founders of Anderson Advisors. Toby Mathis is with us. Welcome, Toby.
Hey, thank you, Doctor.
Yeah, absolutely. And so, Toby, I saw that you had a pretty illustrious career in helping tons and tons of people and doing really awesome stuff. Can you tell us a little bit how you got to where you are right now?
Oh, boy, that's a good question. And thank you, first off. I've been at it for about 25 years. I'm an investor, first off, so I do what my clients do, and I love working with people that are trying to build wealth and create a legacy. Been really, really lucky over at Anderson. We have about 500 employees. We've had a bunch of awards for our values and things that really matter, like best places to work, along with some other stuff. But I've just been really, really honored to work with the people that I work with and get to work with really cool investors who are making changes. For whatever reason, that just brings me a ton of joy.
Yeah, that's really cool. And I mean, that's actually something that we have in common, even though I'm not so much on the tax and tax planning side or estate planning side, even though I can say lucky or rightfully so, I guess you would say, Toby, is to have an estate plan and get it all worked out. And I've actually had the first benefit from it because I wanted to know what I would have to do if I wanted to give one of my investments to my daughter. They said, not really anything. It's already in your estate plan. So that was actually a pretty cool thing. With that being said, you said you do these things that you basically help your investors and your customers. That's the same thing that I do, just more on the active investing side and more kind of narrow. You guys, I think from what I could see on the website, you support people pretty broadly. But I'm kind of wondering, especially in this time that we're in right now, right? Like everybody's talking about inflation, everybody's talking, or some people talk about Social Security running out of money, massive national debt that will lead to potentially increased taxes, which might make this whole notion that you do your 401k, you put money aside, hoping that your tax burden will be less when you're finishing with your dependent work than it is right now. Can you put a little bit into perspective what you see and where you would say people should focus on, especially taking into consideration, I would say, the change times that we're in this year compared to like maybe 2021 and 10 years before?
Yeah, and I'll put it this way. So by trade, I'm a tax attorney. So I spend most of my day digging into ways to make sure people are not on the road to overpaying. You pay the legal minimum, right? But inflation is a tax. And if you don't prepare for it, it's absolutely going to annihilate you. Inflation is, if we use the 1980 standards, 1982 standards that everybody compares what we're going through right now, hey, it's the highest inflation since 40 years. No, it's much higher, because if we use the methodology that they use, we're probably closer to 17%, right? That we've never experienced anything like this. They dumped close to $4 to $5 trillion into our society. The Fed is who I refer to as they created more money. during the pandemic, and they absolutely devalued your dollars. And so what would I be investing in? Anything other than dollars. The dollar's strong, but I would be investing in assets that inflation and growth boost. That's how the stock market goes up, is inflation and growth. That's how the real estate market goes up. It's demand and inflation. So if inflation is going rampant, that's where I'd be running to. I wouldn't be going to growth stocks. I'd be focusing on bread and butter cash flow companies that are profitable, have been for 50 years plus, that pay their shareholders, reward you for being a shareholder. And I'd be focusing on cash flow real estate. I would not be messing around with hoping for appreciation on either of those two. Where you find success in this type of market is having cash that comes in monthly or quarterly at a minimum consistently, and that goes up as inflation goes up.
Yeah, absolutely. And I'm totally with you. And I mean, in a sense, I said to a lot of our clients, because as you probably know, we are basically working and helping people to do actually value investing with a really strong percentage, like in the 70% area on real estate. And we have always pointing out that it's kind of like the cherry on the icing on the cake that we had this pretty substantial appreciation in the last few years. But because of the investments that we are promoting being basically selected based on the performance, meaning like the cash flow performance and the positive cash flow from day one, it has always, and I think it's an important thing, it has never been the focus, the appreciation. It has always been the cherry on the icing of the cake. And that obviously is something that we realize is probably not going to be there anymore. But, the cake is still great, even if the cherry isn't on top of it all the time, right? So that's definitely an interesting thing. One thing I wanted to come back to, and really because you're the expert or one of the experts, is, and I call it a dance, just to preface that. People have heard me say this in other podcasts. You said earlier, we are basically helping people to use the full playbook of tax preparation to get it down to as low as possible within the rules.
Yes.
In my words. You said it probably a little better than that. But what I call the dance is the struggle of qualifying, and not just from owner-occupied investments in real estate, but especially for investing in well-performing cash flow real estate, because the question oftentimes, especially when we talk about accreditation, and we're not at the $1 million valuation yet, which just, I want to reiterate this for people, right? Like, so you might have 10 properties that you financed 80% bank, 20% on your own, that might be worth $1 million, but only $200,000 of that, maybe plus a little bit from the cherry, counts. The rest, the loans and the value that the loans basically represent, doesn't really count for accreditation. So for a lot of people who don't have 30, 40, 50 properties yet, the income is basically the thing. And we would turn to you, Toby, and say, hey, man, especially if I'm a business owner like me, I would say, can you help me get it down to as low as possible? With the caveat that I've run into several times and our clients run into, that they say, well, but now your AGI, your adjustable gross income, is below 200 or below 300, and you don't have $1 million yet, so you're not really accredited, and all these cool things out there don't apply. So how do you dance on that dance floor?
I see what you're saying is you're worried about, what if my deal flow dries up because I'm not an accredited investor, and could I do tax strategies that cause me to lose my accreditation? And
if I even had it, right?
Yeah, that's a valid concern. What I would say is not all syndications are for 100% accredited investors. A lot of them have room for 35 or so of the non-accredited, but it is a consideration. Absolutely 100%. What we end up doing is, I'll give you an example of what I went through when I started our firm, Anderson. We had a few years where we were making $1 million, but we were writing everything off. We were accelerating depreciation. We had zero, right? So I go in to get a home loan, and they're looking at you like you're a pauper. You make no money. No, I made $1 million. Oh, so you're tax cheap. No. It's like, you end up talking to the banker, and they have to be able to read a balance sheet and understand that maybe you accelerated depreciation. Okay, they're going to add it back in, depending on it. But if I don't want to deal with that, report more income, right? If my level is, hey, I need to show that I'm making $200,000 a year if I'm single, or $300,000 a year if I'm married filing jointly. If I want to meet accredited investor status, and 2, and then I have to continue believing that I'm going to continue down that path. Hopefully that gets you over the $1 million net worth side. But if that's what your plan is, then you're deliberately overpaying the taxes that you owe. Instead of deferring them out, maybe you're paying them now, but you're doing it intentionally, not by accident. You're saying, hey, this is what I want to hit. And if you would have had 500,000, we're not doing 500,000 because it's not doing you any good. We're going to get you down to that 300,000, right? So if I need to meet accredited investor status, how do I do it? All right, let's target that number. Let's not overpay. Let's not underpay. Let's make sure we're hitting what you want to be so you have access to these deals. Or if you're somebody who doesn't want access to those deals, like I would say, hey, if I have to choose between paying 15, 20% tax rate so I could get a deal that's going to give me 8% or 9%, I might say, hey, let's do the numbers there. You're probably better off not paying the tax on it right now and then accumulating wealth. As long as it's going into investments, you'll hit accredited investor status. It just might take you a couple years.
I appreciate that. And that actually brings up two questions. One of them being, how close around that accreditation number of 200 or 300 do you think it is even worth playing around with it? I mean, let's just say somebody had single and had 180 if you do everything, but you could get to 201 if you don't do everything. I know you can say, okay, well, what's the percentage on the return? But the return is only really known year one, right? Mm-hmm. Like, I mean, and I want to play this out a little more. If you're looking at what's happening in the market, at least in our real estate market, that we are looking in for well-performing cash flowing properties, we see, yes, the properties have increased in value and the money we need to pay for the money that we want to use for leverage has gotten more expensive. But when we go to our principle to say a good property is only a well-performing property if it pays positive cash flow, taking everything into account, then that is still true. But then the point is, okay, if I interpret the market correctly, there will be way more demand for renters or tenants than people who buy something other than for investment purposes. So yes, I could say my initial right now, you might be right to say, okay, well, you're starting out with 8%, 9%, 11%. But if I'm looking of how much most likely will I get in the next few years, and none of these investments are short-term anyways, right? Correct. So does it make sense to say, okay, at some point, if you're within 20, 25,000, you might want to talk to your CPA or sign up with Anderson Advisors?
Yeah, it's doing it deliberately. And I'll say that if it really comes down to that's how close you are in accredited investor status, the whole idea with accredited investor status is that you can afford to lose that money and it's not going to change your lifestyle. If you lost your money, you'd probably have to change your lifestyle. So I would say, hey, make sure that you're comfortably into that $1 million range or that you're comfortably at the income threshold, because it's designed to kind of keep you from doing too many things that could harm yourself. So that would be my first comment. But yes, absolutely sit down with your accountant at that point and say, is there anything that I'm not like that I can take that I'm absolutely not going to get a return on? So I am overpaying my taxes rather deliberately. Mm-hmm. Are the returns going to justify it? And it really depends on the investment that you're in. I happen to agree with you, by the way. We are underbuilt. So the Joint Housing Center, the Harvard Joint Housing Center, says 3.8 million units behind, depending on who you look at.
I personally think it's more than that, but it depends on what units you're counting.
Yep. We have a housing issue. Yeah. We don't have enough housing. And we're losing housing. And now the Fed decided to raise interest rates to break the economy, to stop inflation, which they created by dumping the cash in, but they're not pulling the cash out, which would be the obvious solution. But let's just say, hey, we're going to really hammer this thing. So now builders aren't building. So now new builds are down historic levels. You have interest rates just jumped at the fastest rate we've ever seen for mortgages. I'm trying to think of how far back you have to go to see this type of jump. I don't know if it's ever happened where they doubled in 6 months. I don't think
that jump, I agree. The jump has probably never been this big. The rates are probably about like early 2000s, similar to that kind of.
It's crazy.
Yeah.
So what's going to happen to the market? You're going to have people that now can't afford. So the affordability of real estate, I don't think it's ever been this bad. The median home and the median income, it would take about 45% of the median income to pay for the mortgage on the median home. It's untenable. There's no way that that's going to continue. So something's going to have to give, so either people aren't going to be able to afford the house, which means they become renters, which then if you're a landlord, this is fantastic for you, or you're going to have continued inflation where we're going to have to see wages increase so that the median income can afford the median home, or you're going to see that median home get it devalued so that it's in line so people can actually afford it.
I agree with all of those. And I mean, I obviously have my prediction. One additional component, and that might be a little bit outside of the frame of our conversation today, but I think an important component in this is not just the sheer numbers, but the fact that the pandemic has basically shown that for anything that is not hands-on kind of work, where you either participate in creating a product or you have to be in a particular location so that a service can be provided. I mean, I'm assuming you could do what you and I are doing now as far as talking on a podcast for a tax advisory session just as well. I don't have to come and sit with you in an office, right? And so this component of people saying, okay, well, if I want to work in the tech industry, I have to be in Silicon Valley is no longer true, right? So that gives a potential shift in where people actually are even going to look for any real estate, whether it's to be rented or to be bought. I believe is going to see accelerated shifts because the circumstances are being created, whether it's the high cost of money or the high cost of rent, for people to basically reconsider, okay, what do I really want and what do I really need? It used to be if you wanted to be at the bleeding edge of high tech, you needed to be either in some place in North Carolina or in Silicon Valley and a few other spots, and the rest of the country was basically out. Well, now the whole country and even outside the country is basically in, right, for those kind of jobs. And so that, I think, is a new layer that we didn't really have, and everybody was always arguing, at least as long as I has been working, that wouldn't work. Well, 2 years of the plague have basically shown that it does work,
Yeah, the numbers are ridiculous. It used to be, 4% of the people worked from home, and now it's over 30%. Yeah, it is.
Yeah.
It is.
And most of them, I think, would, if given a choice, from what I hear, and I work with very many people, especially in the life science and healthcare industry and stuff like that. When you ask them straight out, one-to-one without their employer listening, nobody wants to actually go back. And that doesn't mean they don't like the community and don't like to go and have an event at the office or maybe for something to come together as a team, but not every day spending 2 hours in a car to go and sit in a cubicle or anything like that. So I think that creates a dynamic. Now, one thing I want to come back to what you mentioned earlier, and that is you said, okay, well, you either have 200,000 yourself as adjusted gross income or 300 if you are filing together with your spouse.
Yeah.
Now, I know a lot of our people in the audience are either people who have a normal W-2 job but make basically almost all the income, or they're business owners. So I want to really take advantage of the fact that we have you, Toby, to say, how is this actually? If, like, take my example, right? I have 2 businesses. My wife obviously helps me, but she's not an employee or anything like that. Is it really kind of smart to keep filing together or separate or under these, different opportunities and circumstances for qualifying? It might be that I could, if I were singly filing, be there easy, but if we file together, I'm 50,000
you
shorter.
might be better off. Usually you're better off if you're filing jointly. There are a few situations where you're better off filing separately. And the only way you're going to know is when you do your taxes, have your tax guy or tax gal run 2 scenarios. What if I file jointly? What if I file separately? And it varies. I've been kind of shocked because I'll be like, there's no way it's going to make that much of a difference. And you'll see occasionally, depending on what's going on with those individuals, where it will make a big difference. If you're doing the whole real estate professional, if one spouse qualifies and one spouse doesn't, and you're going that route, then it might have a huge difference. If it's somebody who's just, hey, one person has a high W-2 job and that you have a homemaker or the other spouse is staying home, then it might not make much of a difference at all. And so it's just, again, I would say there's 3 rules in taxes, which is you calculate, and calculate. At the end of the day, don't guess. Just have your guy run 2 different scenarios. It's the same thing we do with businesses. Well, would I be better off as an S Corp, C Corp, sole proprietorship? Well, let's run the numbers. And hey, look, and then you look at the other considerations.
That's good advice to actually run it as if it is two scenarios. I mean, one of the things that you said earlier, I think is an important nugget, and I really appreciate that you pointed it out. And that, in my words, I would call it to do things with awareness, consciously basically making the decision, right? Like in my case, because we knew that I'm most likely going to be the one who is generating the revenue, generating ultimately the profits in the business. So for all the investment loans, my name is basically the one that is on the title, is in the mortgage and stuff like that. And we have never really pulled that trigger, but we've always been saying, okay, well, if I were to be the one who's basically the only one filing, then every piece of documentation, both on the income side as well as on the quote unquote expense side, is in my name. So I can actually use all of it, right? And we then made sure in the estate plan that my wife still gets everything if I get run over by a bus, so.
Can I touch on that just real quick? Because I think that I literally just went to a funeral this weekend of a client that was involved. They were a syndicator, and they had construction business, and they had just gotten married. It was 104 days from their marriage to when the individual passed away. He was hit on a motorcycle by a drunk driver. Actually, the drunk driver pulled out in front of him on the freeway, like literally. Yeah. That was all she wrote. Please have an estate plan in place. If you think it's never going to happen to you, you got to understand that simple documentation avoided all the consternation for the surviving spouse. Everything was already documented. Thank goodness they knew, because I've been chirping on him. As soon as you get married, we're fixing that thing. He had already had an estate plan and he was getting married. We updated it. Thank goodness we did, because the ramifications of that event would have been potentially catastrophic. It depends on the state you're in. He had children from a previous marriage. There's business interests. There's stuff that pre-existed the marriage. All this stuff is handled when you do an estate plan. And I'm not talking about a will. I'm talking about an actual estate plan, usually in the form of a living trust, with all the ancillary documents, which is the power of attorneys and the financial power of attorneys, healthcare power of attorneys, HIPAA releases, all that. You want to make sure that is dialed in so that you're not leaving your loved one in peril. All the investing in the world can get undone in a heartbeat if you're not looking at, what am I creating? What is the legacy I want? Because it'll get undone by your relatives and your heirs if you're not very specific. They literally won't know what to do with it. And you're creating an issue for them to have to solve, and they don't have your expertise. And so if you're leaving things to your kids, if you're leaving things to a spouse, and like you said, they may not even be on the documentation. They may not know what's going on. They may not be working in the business. Please make sure that you're having some format of how that's resolved. So, because if it ends up in a courtroom, or worst case, if it's a lot of obscurity, like we don't know, and eventually you end up in a courtroom, it's usually the death knell for whatever plan you put in place. If you want to create a legacy.
Absolutely. Yeah, I really appreciate, Toby, that you make that really sincere point, and I'm harping on this myself, especially when, as it has happened and keeps happening, some of our clients don't just use our help to basically get in the groove and get their first and maybe their second investment, but have kind of like a lifelong relationship, and they keep building their portfolio. We call that working or being on the path towards the time freedom point, where you no longer have to exchange time for money and can live
100%.
off your cash flow. But with that, obviously, comes the accumulation of assets, and not just equities, but assets. And so we basically using and suggesting a series LLC type structure in the estate plan, so that basically, like you just said, everything is organized. And if you make it to that point, right, then you become dependent on that passive income, and you don't want to have any doubts, because you haven't organized it and you don't have it in the estate plan, how exactly the funds are flowing. And also, I mean, the nice thing, and I want to use that a little bit as a bridge to your 5-point system, that you have to have somebody, whether it's Anderson Advisors or some organization similar to it, that is aware and every year creates basically a summary of how does the structure look and how much is it still relevant to any additional investments you have made this year, or any things that have changed, or maybe the allocation needs to change. That's basically and you said it in the beginning, right? Like doing the things that you want to tell other people. So it's not just doing the investments. I'm also basically always saying, if you want to hear what I have and how I have structured my estate plan, I can tell you. And then you can take that, copy that, do something similar, and even to address things like, I know people always ask me, oh, so if I do this thing with the estate plan, will all my mortgages be called? Right? And so I tell them, well, I'm not an advisor. I'm not anywhere near at your level. But if you put your property in a land trust and the land trust is owned by the LLC and that routes up to your operations company, it's all good and there's nothing to be called. Right? And so those kind of things I think are really helpful. And so I hope, and I don't know if this is something putting you on the spot to explain that in relatively just a little bit of time. I have this elf in the background called Nadine who makes things that you and I can talk and be on a podcast possible with and organizing and stuff. And she always sends me a few notes and she said, Toby worked through all of this and did all of this and hundreds of millions and thousands and millions. But overall, what he came up with is a surprisingly easy 5-part plan. And I'm like, oh, that sounds cool. I have to ask him about it. How is this secret, surprisingly easy 5-part plan? What is it and how does it work?
We call it the Anderson system, and it's basically You're taking inventory of all your assets and you're putting together a blueprint. So you're trying to see where things fit. And like you just said, you use a series LLC or you're using a land trust to hold the real estate. You're just putting things in names that are not your personal name. Because if you die personally, or if you're sued personally, that asset is right there to be taken. So you want to have it in some sort of entity structure. And that's usually what you're doing. First off is you're putting together an inventory, you're doing a blueprint, you're putting together a tax structure on top of that. You're looking at saying, is there a tax advantage way? You just do step. Then annually, you're looking at the compliance and you're just making sure you're doing your tax returns, you're filing things with the state. And then you look for advanced strategies as you grow. So if your business takes off and you say, hey, is an ESOP available to me or defined benefit plans? What type of retirement? Should I be using index universal life or variable universal life or any of these other things that are available? And you're just looking at those on an annual basis. If you just did that every year, just walked through those simple steps, inventory, blueprint, tax, compliance, advanced strategies. You just do that every year. It's actually fairly simple. It's not rocket science.
Right. Yeah. Well, I think it's fairly simple when you build trusting relationships. I think, in my opinion, this is what it ultimately comes down to, right? I mean, the guy that I have my estate plan from said the same words, Toby, that you used, and said, it's actually fairly simple. I said, well, I looked at it. I saw these 200 pages of stuff and going to the notary twice for all these documents for the different county assessors and what have you. That doesn't look like fairly simple to me, but we have this trusting relationship with each other that has grown over time. And like you said, if you do the review year over year, the trust is ultimately that makes me sleep well, because I know the Tobys of the world make sure that I know what I need to know or do what I need to do to keep building in the direction that I want to build. And as you mentioned, the compliance is making sure that I'm doing it within the rules and within the frame that the government gives us. So can you touch a little bit on how you build that trusting relationship with your clients?
You want to have somebody that does what you do. I would say the number one thing that you need to be able to have is open communication and somebody who understands what you're doing. It's really tough to understand a business owner or an investor unless you're a business owner or investor. It's exceedingly difficult. So when you go to professionals and you say to your attorney, hey, I've invested in a syndication, I'm doing multifamily, I'm doing single family, I'm doing manufactured homes, hey, I invested in this syndication, or I'm doing this one over here. I have a series LLC holding my investments. And they're looking at you like, I've read about that. That's about the scope of their knowledge of it, right? They don't know the nuances. They don't know how hard it is. They don't understand depreciation. They don't understand those things. They may have read about it somewhere, but that's not what they do. Right. You want to work with people that do what you do. If that's all you did is found, hey, I want to find a lawyer, an accountant that do the same type of investing I do, that are in these same waters, they understand where I'm coming from. They probably do it for their returns, so I don't have to pay them to learn it. They're doing it, so they could just give me all the nuggets and they'll tell me how to do it. So when they, for example, your counsel put together your plan and he said it's simple. It's not easy, but it's simple.
Yeah.
A, B, C, D, E, F, right? 200 pages, but it's systematic and it's very simple from an attorney standpoint. You're looking at it going, that makes perfect sense. We don't have to go to the court. We can do this. We have a trustee. We have a successor. This thing's going to live for at least 300 years. We don't have to worry about all this nonsense. We don't have to go to court and argue and fight, and it's a lot less expensive. And they're looking at it going, this is great. And you're looking at it going, you just handed me 200 pages.
Yeah, exactly. Although I have to say, he knows me well enough. When we started working together, he sent me the 200 pages, and every so many pages there was a little sticky that said sign here, right? And so I started reading the first like 2 or 3 pages and said, no way, that sounds like Chinese to me or stuff. And so I basically signed where the stickies were, and he could.
As long as you understand it. Here's the rub with an estate plan. It's got to be simple. And it's not whether you understand it, it's whether your surviving spouse or kids or your heirs understand it.
Yeah, if I translate what you just said, Toby, into my words, is understanding in my words means I have expressed to somebody, what do I want to achieve? What it is, what is it supposed to accomplish? Right? If I say, okay, it's supposed to make sure that legally nobody can say just because you run this business, we're basically taking your house away, right? And break the corporate veil or stuff like that. So I want that protected. I want to make sure that there is not a ton of paperwork or courts to actually go after each one of the properties or after each one of the stock investments or gold coin investment or whatever it may be. That is all that I basically want to have to express. The ins and outs on how you put that in the right forms, in the right papers, and file it with the right authorities, that's where I'm coming from with a trusting relationship, right? So that's why I'm also saying, like we're doing the podcast and we're inviting great guests like you to give people options to say, okay, I'm at the point where I need Toby. I'm at the point where I need Axel. I'm at the point where I need Frank or Chaley or whoever it might be, because ultimately I think, and I hope you would agree, what we end up doing in the process of building all of this is not just building the assets, but also building a network of relationships where we have a certain contribution and all the other partners in the relationship have their expertise to contribute. And ultimately everybody succeeds and everybody can have their success within it. So I think if we can realize that, when you said earlier, we need to be aware to make conscious decisions, I think that's actually what makes the journey also interesting, right? Like to know.
What I like to do when I sit down with a client a lot of times is I say, what do you see your estate looking like in 200 years?
Yeah, exactly.
Because it removes them from the scenario. Now they're long gone and they're saying, I would really like it if my family was able to get the benefit. I'm like, what benefit and why? Because I want them to be able to travel. I want them to be financially free. I want to create, towards what end? You want them just to be able to not have to work ever? Or do you want to inspire? Like, what's the point? And you usually get down to something where they're transferring their values. Maybe they want to be able to do mission work. Maybe they want to be able to do more charitable giving. Maybe you want them to be able to go to school. Maybe you want them to be able to travel outside the United States so that they get a little more worldly. All of that starts to come out, and then you can put together a plan. I see people go to lawyers all the time, and the lawyer just automatically says, you want your kids to get it at what ages?
Yeah, exactly. Yeah, no, you're absolutely right. And I think you put that very nicely for anybody in the audience and to actually catch that. So I'm sure Nadine told you, but one of the things that don't have anything to do with tax preparation or things like that is one of the questions I always ask. And that is, if you had a time machine, Toby, you could go forward or backwards. You know what you know. You can come back, but you're not allowed to change the time-space continuum. Where would you go and why?
It's interesting. Really good question. Honestly, I love right now. I wouldn't get in the time machine.
Right.
But if I had to go back, I'd probably go back to when I was a real young man so I could see my grandparents and my family again, knowing that I was able to go back. But I wouldn't go there and try to invest or anything. And, that wouldn't be right. I'd be cheating. I'd have insider knowledge because I'd already lived it.
Exactly. I agree with you. The one thing that I found, and I don't know if you say yay or nay to that, is that the older I have gotten, the more of those kind of one-liner statements. I remember like one maybe applicable to our current times. My grandpa used to say is never trust a statistic that you didn't manipulate yourself. So and there were many of those. And I'm the first to admit when I was younger, I probably had them somewhere in the very deep, dark crevices of what I call a brain. But they didn't really come forward. And the older I got, they kind of started coming forward, or somebody said something that reminded me of them. And now I'm not really trying to say I'm becoming my elders, but I'm realizing how many of those statements and those one-liners that they dropped here and there, probably with some intention that I didn't get at the time, how profound they actually were. And so similar to what you said, I would love to go back to some of those times and just get the whole context. Because sometimes I really only remember what the statement was and it makes total sense, but I have no recollection. What was the circumstance? Like, what statistic did we look at when he said, you got to be kidding me. That is never going to be true.
I always think of it as like, what was it, Talladega Nights, when he's confronting his dad on the road. And he's saying, you always said that if you're not first, you've lost, or something along those, right? Yeah. He goes, I said that? That's what I always assume that I'd be going back and saying, remember when you said this? He goes, that's not what I said. But it had a huge impact on my life, so it's your interpretation of what they said quite often.
Yeah, when we were starting today and you said, like if you look at inflation, the true inflation is probably more like 17%. That immediately reminded me of my grandpa saying, because literally, you won't believe it, but Germany last month is where I'm coming from, so I'm still connected family and stuff, reported that their inflation is something like 6.8%. And I'm like, okay. So you're buying more expensive gas, more expensive oil, more expensive electricity. All the other raw materials have just increased for you as much as anybody else in the world. And your inflation is lower than everybody's in the world. And immediately, like, grandpa, that's only for the news media. So, So that's cool to go and kind of see the context. That would be really cool. All right. So, Toby, I think you did wonderful telling us the 5 steps and how important it is to recognize them, get advice, and then repeat them every year. So if somebody said, wow, that Anderson Advisors guy, that sounded interesting. How do they get in touch? What do they need to do to?
Easiest thing is you just type in Toby Mathis in the internet and you'll find me. I'm all over the place in my firm, but AndersonAdvisors.com is a simple route. I say that generically because you really do want to do your homework and you want to start taking in what our values are, because we are very specific about who we are and who we work with and why we do what we do, and see if it's aligns with yours. Because I'm the first one to tell you that we're not everybody's cup of tea. But if you're an investor and you want to protect your assets, you want to create a legacy, we're a really good fit.
Yeah, absolutely. And I also subscribe to it has to fit, right? It has to be kind of like the lid on a pot. And if it doesn't quite fit, then you might want to keep looking. The other part, and you were maybe too modest to say it, but I'm going to say it. And that is, if you see yourself, at least to some extent, as an investor, then working with Toby and organizations like his or similar organizations sooner rather than later, I would say, and this is my advice to our audience today on this show, do it sooner. Because rolling it all up when you have 10, 15 properties and all kinds of different asset classes and all kinds of retirement plans and stuff like that is doable. And I'm sure, Toby, you and your team can do it. But if you make it as an iterative thing over time, it is so much easier and you become so much more familiar with it. And I believe it helps to build these trusting relationships when you creating and planning for the growth of the future, rather than to say, okay, now I have a $3 million portfolio with 27 different things and nothing is properly organized, right? And then you go to that nightmare for 6 months before it's organized and you can go forward. So I hope that you don't mind me giving that on top of just finding the right partners.
It's easier to do it right from the beginning than it is to fix something that wasn't done right. Mid-level, midstream. It's a little bit disruptive, but it can be done. But I would say it's just so much simpler if you just did it right from the beginning.
Exactly. You said it so much more concise. I wish I could. Anyway, Toby, awesome that you were here, that you spent time with us. And to you and your 500 other employees. We wish you all the best. And anybody who is listening to us and says, hey, I mean, that really makes sense to me and maybe I'm at the point where I should get started, then we will put all the links and stuff in the show notes so people can easily find it and get in touch.
Absolutely. Thanks for having me on.
Absolutely. Thank you so much. And maybe we do it again at some point.
Absolutely.
Thanks for listening, and I hope you enjoyed today's episode of the Ideal Investor Show. More info and the links we mentioned during the show are in the show notes, or you can go to our website at idealwealthgrower.com and sign up for the Apple Podcast link. And if you like to talk to me, sign up for a strategy call. Hopefully you want to share what you learned with your network and bring more people in. We are really eager to hear your comments. And until next time, be well, stay safe, and ciao.